Hello and welcome to the Investing Iguana, where we help you grow your wealth with smart and savvy investing tips. I'm your host, Iggy, and today we're going to talk about a topic that's been heating up in the financial world: gold. Yes, gold. The shiny metal that has been used as a store of value for thousands of years. The metal that has fascinated humans since ancient times. The metal that has been the subject of countless myths, legends, and movies. But why are we talking about gold now? Well, because gold is making a comeback. A big comeback. In fact, some experts are calling it the golden revolution. The highest level that gold reached in nominal terms was $2,074.88 per ounce on August 7, 2020. This was due to the economic and political uncertainty caused by the global COVID-19 pandemic, which increased the demand for gold as a safe haven asset. The current price of gold right now is $1,965.20 per ounce. This is based on the live spot gold price, bid price, as of May 31, 2023. That's impressive, especially when you compare it to the performance of the broader U.S. equity market and a key gold index over the same period. The S&P 500 index, SPX, dropped by nearly 19% and the Bloomberg Gold Subindex, BCOMGC, dropped by over 7% in that time frame. So what's driving this gold rally? And more importantly, how can you profit from it? Well, there are several factors that are boosting the demand for gold right now. Let's go over them one by one. First, there's inflation. Inflation is the general increase in the prices of goods and services over time. It erodes the purchasing power of money and makes everything more expensive. Inflation has been a major concern for investors lately, as the U.S. economy has been recovering from the pandemic-induced recession. The massive stimulus spending by the government and the ultra-low interest rates by the Federal Reserve have pumped a lot of money into the system, creating inflationary pressures. The latest inflation report from the U.S. Bureau of Labor Statistics showed that the Consumer Price Index for all urban consumers, CPIU, rose by 6.2% year-over-year in October 2022, the highest rate since November 1990. That's way above the Federal Reserve's target of 2% for the Personal Consumption Expenditures, PCE, price index, which is a different and broader measure of inflation that rose by 4.7% over the same period. Singapore's inflation rate has risen to 5.7% in April 2023, the highest in over a decade, due to higher costs of oil, food, housing, utilities, and services. The authorities have revised their inflation forecasts upwards and will take policy actions if needed. They also expect inflation to moderate in the long term. Inflation can have negative impacts on consumers and businesses, such as reducing their purchasing power, increasing their living and production costs, and creating uncertainty and volatility in the economy and financial markets. Now, why is inflation good for gold? Well, because gold is seen as a hedge against inflation. A hedge is something that protects you from a negative outcome. Gold is a hedge against inflation because it tends to retain its value over time. Unlike paper money, which can be printed endlessly by central banks, gold has a limited supply. There's only so much gold in the world, and it's not easy to mine more of it. Gold also doesn't pay any interest or dividends, so it doesn't lose its appeal when interest rates are low or negative. In fact, low interest rates make gold more attractive because they reduce the opportunity cost of holding gold instead of other income-generating assets. So when inflation is high and interest rates are low, investors flock to gold as a way to preserve their wealth and avoid losing money in real terms. That's exactly what's happening right now. Investors are worried that inflation will continue to rise and that the Fed will be too slow or too timid to raise interest rates to combat it. According to the latest economic forecasts released by the Fed in June 2023, the Fed may hike rates 5 times in 2023. The Fed has already raised rates twice this year, in February and May, by 0.25 percentage points each time, bringing the Fed funds rate to a range of 5% to 5.25%. The Fed is expected to raise rates again in August, November, and December by 0.25 percentage points each time, bringing the Fed funds rate to a range of 6% to 6.25% by the end of 2023. The Fed has accelerated its pace of rate hikes as inflation has been higher and more persistent than anticipated. But some investors think that's not enough or too late to rein in inflation. They fear that inflation will become entrenched and spiral out of control, leading to high inflation growth. High inflation growth is a situation where the economy experiences both high inflation and moderate or high growth. High inflation growth is bad for stocks because it reduces the real value of future earnings and dividends, which are used to value stocks. High inflation growth also increases the risk premium that investors demand to hold stocks, which lowers their prices. High inflation growth may also force the Fed to raise interest rates more aggressively, which could slow down economic activity and hurt corporate profits. High inflation growth is also bad for bonds because it erodes their value and pushes up their yields. But high inflation growth is good for gold because it increases its appeal as a safe haven asset. A safe haven asset is something that investors buy when they are fearful or uncertain about the future. Gold is a safe haven asset because it tends to retain or increase its value when other assets lose value or become risky. Gold also acts as a hedge against inflation, as it preserves its purchasing power when the value of money declines. Gold may benefit from high inflation growth because investors may seek refuge from the uncertainty and volatility of the economy and financial markets, and because gold may outperform other assets that are negatively affected by inflation and low growth. Gold is a safe haven asset because it has a long history of being accepted as a medium of exchange and a store of value across different cultures and countries. Gold is also independent of any government or central authority, so it cannot be manipulated or devalued by political or economic events. So when stagflation looms, investors turn to gold as a way to protect themselves from the volatility and risk in the markets. That brings us to the second factor that's driving the demand for gold right now: geopolitical tensions. Geopolitical tensions are conflicts or disputes between countries or regions that affect global stability and security. They can range from trade wars to cyberattacks to military interventions. Geopolitical tensions are bad for stocks because they create uncertainty and disrupt trade and commerce. They can also trigger sell-offs and panic in the markets. But geopolitical tensions are good for gold because they increase its appeal as a safe haven asset. As we said before, gold is independent of any government or central authority, so it cannot be affected by political or economic events. Gold is also seen as a universal currency that can be used in times of crisis or emergency. Gold can be easily transported, stored, and exchanged across borders and jurisdictions. So when geopolitical tensions rise, investors turn to gold as a way to hedge against the potential fallout and chaos in the markets. That's exactly what's happening right now. Investors are worried about the ongoing war between Russia and Ukraine, which has caused significant disruption to global markets and supply chains. The war has also led to a sharp rise in energy prices, which is contributing to inflation and slowing economic growth. Russia is a major exporter of oil and gas, and the war has disrupted supplies to Europe and other parts of the world. This has led to a sharp rise in energy prices, which is putting upward pressure on inflation. Inflation is already at a multi-decade high in many countries, and the war in Ukraine is only making it worse. The war is also disrupting supply chains, which is making it more difficult and expensive to get goods to market. This is leading to higher prices for consumers and businesses alike. The war is also causing uncertainty in the global economy, which is making businesses less likely to invest and hire. The war in Ukraine is having a significant impact on the global economy, and it is likely to continue to do so for some time. Investors are worried about the impact of the war on the global economy, and this is causing volatility in financial markets. The third factor that's driving the demand for gold right now is the strengthening of the U.S. dollar. The U.S. dollar is the world's reserve currency, meaning that it is widely used and accepted for international trade and transactions. The U.S. dollar also influences the prices of commodities, including gold, which are denominated in dollars. The U.S. dollar has been strengthening lately due to several reasons, such as massive stimulus spending by the government and its positive impact on economic growth and recovery, the Fed raising interest rates 5 times in 2023, and improving economic outlook for other countries and regions despite Europe's war with Russia and China's slowdown. A strong U.S. dollar is good for stocks because it increases the earnings and competitiveness of U.S. companies that do business overseas. It also reduces the cost of imports and eases inflation pressures. But a strong U.S. dollar is bad for gold because it makes gold more expensive and less attractive for buyers who use other currencies. It also decreases the value of gold in dollar terms, as it takes fewer dollars to buy an ounce of gold. So when the U.S. dollar strengthens, investors turn away from gold as a way to hedge against the loss of purchasing power and diversify their portfolios away from dollar-denominated assets. That's exactly what's happening right now. Investors are selling gold as a way to avoid the rising dollar and hedge against its further appreciation. So these are the three main factors that are driving the demand for gold right now: inflation, geopolitical tensions, and a weak U.S. dollar. But how can you profit from this golden revolution? How can you invest in gold without having to buy physical bullion or coins? Well, one way is to invest in gold exchange-traded funds, or ETFs. Gold ETFs are investment vehicles that track the price of gold or invest in companies that are involved in the gold industry. They offer several advantages over buying physical gold, such as a. Liquidity. Gold ETFs trade on stock exchanges like any other stock or fund, so you can buy and sell them easily and quickly at market prices. b. Convenience. Gold ETFs don't require you to store, transport, or insure physical gold, which can be costly and cumbersome. c. Diversification. Gold ETFs allow you to diversify your portfolio across different types of gold exposure, such as physical gold, gold futures contracts, or gold mining stocks. d. Tax efficiency. Gold ETFs may offer some tax benefits compared to physical gold, depending on your jurisdiction and tax status. There are many types of gold ETFs available in the market, but they can be broadly classified into two categories: physical gold ETFs and gold mining ETFs. Physical gold ETFs are funds that invest directly in either gold bullion or gold futures contracts. They aim to replicate the performance of the spot price of gold, minus fees and expenses. Gold mining ETFs are funds that invest in companies that mine for or process gold. They aim to capture the growth potential of the gold industry, as well as benefit from rising gold prices. Both types of ETFs have their pros and cons, depending on your risk appetite, investment objectives, and market outlook. Physical gold ETFs tend to be more stable and less volatile than gold mining ETFs because they reflect the actual price movements of gold. They are suitable for investors who want to hedge against inflation, geopolitical risks, and currency fluctuations. Gold mining ETFs tend to be more risky and more volatile than physical gold ETFs because they depend on the profitability and performance of the companies they invest in. They are suitable for investors who want to capitalize on the growth potential of the gold industry as well as benefit from rising gold prices. So which type of gold ETF should you choose? Well, that depends on your personal preference and risk tolerance. But if you want to diversify your portfolio and get exposure to both types of gold ETFs, you can consider investing in a basket of them. For example, you can invest in some of the best-performing gold ETFs in the market right now, such as 1. The iShares Gold Trust Micro ETF, IAUM, which is a physical gold ETF that has a low expense ratio of 0.09% and seeks to track the LBMA gold price. The ETF has returned minus 1.71% over the past year, compared to minus 1.93% for its reference benchmark. The ETF closed at $19.46 on June 2, 2023. B. The Granite Shares Gold Trust, BAR, which is another physical gold ETF that has a low expense ratio of 0.17% and seeks to track the LBMA gold price. The ETF has returned minus 1.71% over the past year, compared to minus 1.93% for its reference benchmark. The ETF closed at $19.43 on June 2, 2023. 3. The Britain Physical Gold Shares ETF, SGOL, which is yet another physical gold ETF that has a low expense ratio of 0.17% and seeks to track the LBMA gold price. The ETF has returned 1.56% over the past year, compared to 1.93% for its reference benchmark. The ETF closed at $18.87 on June 2, 2023. D. The VanEck Vectors Gold Miners ETF, GDX, which is a gold mining ETF that has a moderate expense ratio of 0.51% and has returned minus 1.56% over the past year. The ETF has 48 holdings and $12.3 billion in total net assets as of May 30, 2023. The ETF closed at $30.20 on June 2, 2023. By investing in a mix of these gold ETFs, you can diversify your portfolio and get exposure to different aspects of the gold market. You can also adjust your allocation according to your risk appetite and market outlook. For example, if you are more bullish on gold prices and more willing to take risks, you can allocate more to gold mining ETFs than physical gold ETFs. If you are more bearish on gold prices and more conservative, you can do the opposite. Of course, you should always do your own research and due diligence before investing in any ETF or any other asset. You should also consult your financial advisor or planner if you have any questions or doubts. And remember, investing in gold ETFs is not a guarantee of success or profit. Gold prices can go up or down depending on various factors, such as supply and demand, market sentiment, economic conditions, political events, etc. Gold ETFs also have their own risks and drawbacks, such as fees and expenses, tracking errors, liquidity issues, regulatory changes, etc. So you should always be aware of the potential pitfalls and challenges of investing in gold ETFs and be prepared to face them. But if you are looking for a way to diversify your portfolio and hedge against inflation, geopolitical risks, and currency fluctuations, then investing in gold ETFs may be a good option for you. Gold is a timeless asset that has proven its value and resilience over centuries. And with the current trends and developments in the world, it may be poised for a golden revolution. So what are you waiting for? Join the revolution and invest in gold ETFs today. That's all for today's episode of the Investing Iguana. I hope you enjoyed it and learned something new. If you did, please hit the like button and subscribe to our channel for more investing tips and insights. And don't forget to leave a comment below and let us know what you think about gold ETFs. Do you invest in them? Why or why not? Which ones are your favorites? We'd love to hear from you. Thank you for watching, and until next time, happy investing.